You wake up one morning, check your bank account, and realize the government just took a huge chunk of your money. Why? Because you're self-employed. If you do not understand self-employment taxes, you could be losing thousands of dollars every single year. But here's the good news. By the end of this video, you'll know exactly how self-employment taxes work, how to calculate them, how to pay them, and even some smart ways to lower the amount you owe. Stick with me, because the difference between confusion and clarity here could literally mean the difference between keeping or losing your hard-earned money. Number 1. What is self-employment tax really? Most beginners think self-employment tax is just income tax, but it is not. Self-employment tax covers Social Security and Medicare contributions. In a normal job, your employer pays half of these taxes for you. But when you work for yourself, you are both the employer and the employee. That means you pay the full amount yourself. Right now, the self-employment tax rate is 15.3%. Out of this, 12.4% goes to Social Security and 2.9% goes to Medicare. Let's take an example. Suppose you earn $50,000 in a year from freelancing. That means $7,650 goes to self-employment taxes before you even think about regular income taxes. This is why so many beginners get shocked at tax time. Number 2. Who has to pay self-employment tax? If you earn $400 or more in net self-employment income in a year, you have to pay it. Yes, even if you're only doing gig jobs like Uber, Etsy, or side freelancing. It does not matter if you are full-time or part-time. If you cross $400, the IRS expects you to file and pay. Let's say you are a college student selling designs on Etsy and you make $600 profit. You may not owe much in income tax, but you will owe self-employment tax on that money. This surprises a lot of beginners, but the rule is simple. Cross $400 in net earnings, and you are in the game. Number 3. How to calculate your self-employment tax. This is where people panic, but it is actually straightforward. Step 1. Calculate your net earnings. That means your total income minus your business expenses. For example, if you made $30,000 from freelance writing but spent $5,000 on a laptop, software, and office supplies, your net earnings are $25,000. Step 2. Multiply your net earnings by 92.35%. Why this weird number? Because the IRS says only that portion is subject to self-employment tax. So in our example, $25,000 times 92.35% equals $23,087. Step 3. Multiply that by 15.3%. That equals $3,532 in self-employment tax. It sounds painful, but once you understand the formula, it is predictable. Number 4. Do you still pay income tax on top of this? Yes. Self-employment tax is separate from income tax. That is where people really get frustrated. Think of it this way. Self-employment tax covers Social Security and Medicare. Income tax covers federal and sometimes state tax on your actual income. So if you earned $30,000, you may owe around $3,532 in self-employment tax plus whatever your federal and state income tax amounts to. That double hit is what makes tax planning so important. Number 5. How do you actually pay self-employment tax? If you work a regular job, taxes are taken out of your paycheck automatically. But when you are self-employed, you are responsible for sending money in yourself. The IRS requires you to pay estimated taxes 4 times a year. That means in April, June, September, and January. You can pay online through the IRS direct pay system or by mail. But here is the key. If you wait until April tax season to pay it all, you could get hit with penalties and interest. For example, if you earn $40,000 as a freelance photographer, you are expected to send in estimated payments each quarter. If you don't, you could owe thousands extra in penalties. Number 6. Can you lower your self-employment tax legally? Yes, and this is where strategy comes in. First, you can deduct business expenses. Every dollar you spend for business purposes lowers your taxable income. Second, half of your self-employment tax is deductible on your income tax return. This does not reduce the self-employment tax itself, but it reduces the income that your federal tax is based on. Third, retirement contributions can help. If you put money into a SEP IRA, simple IRA, or solo 401k, it reduces your taxable income. Example, suppose you made $60,000. If you put $10,000 into a solo 401k, you now only pay taxes on $50,000 instead of $60,000. Small moves like this can save you thousands. Number 7. Common mistakes beginners make. Mistake 1. Not saving for taxes. Many freelancers spend all their income and panic at tax time. A good rule of thumb is to set aside 25 to 30% of your income for taxes. Mistake 2. Mixing personal and business expenses. If you keep everything in one account, it is messy and risky. Open a separate bank account for your business. Mistake 3. Not keeping receipts. The IRS does not accept, "I just remember it." You need proof of your expenses. Mistake 4. Forgetting about quarterly taxes. If you only pay once a year, you risk penalties. Avoiding these mistakes can save you headaches and money. Number 8. What forms do you need to file? For self-employment tax, the main form is Schedule SE, which attaches to your Form 1040. You will also use Schedule C to report your business income and expenses. If you receive 1,099 forms from clients, those go into your Schedule C as income. Example, if you drove for Uber, you will likely get a 1,099K. If you freelance online, clients may send you a 1,099 NEC. It may sound overwhelming, but tax software makes this process much easier. You plug in your numbers, and it calculates everything automatically. Number 9. Should you form an LLC or S Corp to save on taxes? This is a question almost every beginner asks. An LLC alone does not save you on self-employment tax. It mainly gives you legal protection. But if you choose to be taxed as an S Corp, you could reduce how much you pay in self-employment tax. Here is how. As an S Corp, you pay yourself a reasonable salary and the rest of your income is taken as distributions. Only the salary portion is subject to self-employment tax. Example, suppose your business makes $100,000. You pay yourself $60,000 salary and $40,000 as distributions. You only pay self-employment tax on $60,000 instead of the full $100,000. But keep in mind, S Corp come with extra paperwork and costs. For beginners, it often makes sense to start as a sole proprietor and move to an S Corp once you are consistently earning higher income. Number 10. Do you qualify for the 20% qualified business income deduction? Yes, many self-employed people do. This deduction, also called the QBI deduction, allows you to deduct up to 20% of your business income. Example, if your net business income is $50,000, you may qualify to deduct $10,000. That means you only pay income tax on $40,000 instead of $50,000. This is not a self-employment tax deduction, but it can reduce your overall tax bill significantly. Number 11. What happens if you don't pay self-employment tax? This is where things get serious. If you fail to pay, the IRS can hit you with penalties, interest, and even liens on your property. For example, if you owe $10,000 and ignore it, penalties and interest can quickly make that $10,000 turn into $13,000 or more. Some people think they can just fly under the radar, but companies you work with often send 1,099 forms to the IRS. That means the IRS already knows what you made. It is always better to face taxes head-on than to run from them. Number 12. The hidden benefits of paying self-employment tax. It may sound strange, but paying this tax is not always bad. Why? Because these taxes fund your Social Security and Medicare. That means when you retire, the more you have paid in, the higher your Social Security benefits will be. So in a way, paying self-employment tax is like building your retirement safety net. For example, someone who consistently pays self-employment tax on $80,000 a year will likely qualify for much higher Social Security benefits than someone who only reported $10,000. It is not just money going away. It is an investment into your future. Number 13. Can you hire your kids to save on self-employment tax? Yes, this is a real strategy many small business owners use. If your children are old enough to do legitimate work in your business, you can pay them a salary. The wages you pay your kids are deductible as a business expense, lowering your taxable income. For example, if you pay your child $6,000 to handle social media, or help with bookkeeping, you just reduced your taxable business income by $6,000. Plus, if your child earns under the standard deduction limit, they may not owe federal income tax at all. This is a smart way to shift income legally while also teaching your kids financial responsibility. Number 14. Can home office deductions lower your tax bill? Yes, and many beginners overlook this. If you use part of your home regularly and exclusively for business, you can deduct a portion of your rent or mortgage, utilities, and internet. The simplified option is $5 per square foot of your home office space, up to 300 square feet. So, if your office is 200 square feet, that is a $1,000 deduction. The regular method allows you to calculate actual expenses, which could give an even bigger deduction. This is especially powerful for freelancers who work from home every day. Number 15. Can your car help you save on taxes? Absolutely. If you use your car for business, you can deduct either the actual expenses like gas, insurance, and repairs, or use the IRS standard mileage rate. For 2025, the mileage rate is around 67 cents per mile. So if you drove 5,000 business miles for client meetings or deliveries, you can deduct about $3,350. Just make sure you keep a mileage log with dates, miles, and purpose of each trip. A simple app on your phone can track this automatically. Number 16. What about health insurance deductions? If you are self-employed and not eligible for an employer health plan, you can deduct health insurance premiums for yourself, your spouse, and your dependents. This deduction goes directly against your income, not just as an itemized deduction. For example, if you pay $8,000 in premiums in a year, that is $8,000 less income you are taxed on. This can make a huge difference, especially for families. Number 17. Can you deduct education and training costs? Yes. If you spend money on courses, workshops, or certifications to improve your business skills, those are deductible expenses. For instance, if a freelance web designer spends $500 on an advanced coding course, that expense reduces taxable income. It is important that the training relates directly to your current business, not a new career. So a freelance writer can deduct a writing course, but not a class on becoming a pilot. Number 18. What about interest on business loans or credit cards? The IRS allows you to deduct interest on loans or credit cards used for your business. So, if you used a small business loan to buy equipment and you pay $1,200 in interest that year, that amount is deductible. Same with a credit card. If you charge only business expenses and pay interest, that interest is deductible too. This is why it is smart to separate business and personal finances. Number 19. Can meals be deducted? Yes, partially. Business meals with clients, partners, or while traveling for work can be 50% deductible. For example, if you meet a client at a restaurant and spend $100, you can deduct $50 of it. The key is keeping good records, noting the date, amount, and purpose of the meal. It may not seem like much at first, but over a year, these add up. Number 20. What about equipment and technology purchases? If you buy computers, cameras, software, or other tools for your business, you can often deduct the full cost in the year of purchase through something called Section 179. So, if a YouTuber buys a $1,500 camera, they may be able to deduct the entire amount that year instead of spreading it over several years. This rule makes it easier for small businesses to invest in growth without being crushed by taxes. You see, self-employment tax can feel like a monster waiting to eat your income. But once you understand it, you realize it is just a system with clear rules. You now know what it is, who pays it, how to calculate it, how to pay it, how to lower it, and even how to use it to your advantage. The real danger is ignoring it. So here's my final question for you. What is one thing you learned today about self-employment taxes that surprised you the most?